All right, let's dive right into this explainer. Today, we're uncovering the invisible machine that banks use to manufacture massive financial profits out of your mortgage. Most of us think we understand how a home loan works, right? You borrow money, you pay an interest rate, and the bank makes a bit of profit over time. Simple. But the reality is entirely different. There are actually 12 hidden profit layers built into every single mortgage, and the crazy part is most borrowers never even see them.
We are going to strip down the mechanics of a mortgage across 3 distinct transaction fronts. We'll start with the tale of 2 borrowers. Then we'll expose front 1, which is the upfront fees. After that, we'll look at front 2, at the closing table, and front 3, the aftermath. Finally, we'll wrap up by arming you with a rock-solid 6-step defense strategy.
Okay, part 1, the tale of 2 borrowers. Let's start with a scenario that perfectly illustrates why literally everything you've been taught about mortgage negotiation might be dead wrong.
Picture this. We've got 2 coworkers. First up is Greg. Now, Greg spent weeks rate shopping. He pitted lenders against each other and aggressively negotiated a 6.75% rate down to 6.25% on a $300,000 loan. He felt like an absolute champion. Then we have Alina. She went to the exact same lender for the exact same $300,000 loan size, but she proudly announced she was putting 40% down in cash. She just assumed her massive cash down payment gave her undeniable leverage.
So Greg drives home from closing, right? He's thinking he completely beat the system. The loan officer even gave him that classic line, telling him they were barely making anything on the deal. Yet the lender actually made over $11,000 on his loan before he even made his first monthly payment. And he never saw a single dollar of it itemized.
And man, this brilliantly illustrates the trap. Elena, who so confidently flaunted her cash position up front, ended up paying $7,800 more in interest over the life of the loan than Greg did. Same lender, same loan size, same exact week. She assumed her cash was negotiating for her. It definitely wasn't.
Moving to part 2, front 1, upfront fees. To figure out how this invisible machine played both of them so well, we have to examine the first of 3 battlegrounds, those upfront fees.
The absolute heaviest hitter of these 12 hidden layers is layer 1, the yield spread premium, or YSP. See, lenders get wholesale rates, let's say 5.75%, but they quote you a retail rate of 6.25%. That gap? That's the yield spread premium. So Greg didn't actually eliminate the lender's markup when you negotiated his rate down. He just negotiated it down to a slightly smaller profit margin. That markup still ended up costing him roughly $32,000 in extra interest over 30 years.
But wait, underneath that interest rate, there are 3 more upfront layers. Take a look at layer 2, discount points. Buyers pay massive chunks of cash up front to lower their rate, but the reality is, most people move or refinance way before hitting that 5 to 7 year break-even point. Then there's layer 3, the origination fee. It's supposedly for labor, but the true labor cost is just a tiny fraction of that $1,500 to $3,000 charge. And layer 4, the rate lock extension. If your closing is delayed, you pay a fee, even though the lender often controls the underwriting timeline that caused the delay in the first place. The bank collects thousands here while taking on virtually zero risk.
All right, part 3, front 2, the closing table. Let's see how this all stacks up at the exact moment you think the haggling is completely over. You're sitting there at the closing table, totally exhausted, staring down an inch-thick stack of paperwork. Your guard is completely down. Right here, the lender captures another $1,500 to $3,000 in pure profit by padding what we call the closing table margins. They charge processing fees, underwriting fees for maybe a few hours of actual labor, and they practically force you to buy lender's title insurance through their own referral network. Then comes the final blow in this stack, layer 9, the markup on wire transfers, couriers, and notaries. It truly is death by 1,000 paper cuts.
So at this point, Greg has signed on the dotted line, he's got the keys, the deal is done, right? But ask yourself, what happens a couple of weeks later when you get a letter in the mail casually saying your loan has been transferred to a new servicer? That brings us to part 4, front 3, the aftermath. That seemingly routine letter actually introduces us to a post-closing marketplace that most borrowers don't even know exists.
This is where we hit layer 10, gain on sale. The truth is, the lender never actually intended to keep your loan. Within weeks, your mortgage is bundled up and sold to entities like Fannie Mae or private Wall Street investors.
The lender sells it for more than they funded it for, usually pocketing a 2.5% to 3.5% margin. On Greg's $300,000 loan, that is an invisible profit of $7,500 to $10,500, literally captured in a single afternoon.
The really shocking reality of the mortgage machine is that this gain on sale generates significantly more profit in one quick transaction than all of those front-end fees and closing table margins combined. And remember, as the borrower, you are entirely locked out of this transaction.
And guys, the machine just keeps on humming for the next 3 decades. Enter layers 11 and 12. Mortgage servicing rights are sold off for massive lump sums. And then there's the escrow float. Your servicer sits on 6 to 12 months of your property tax and insurance money, and they earn interest on your cash while it just sits there. It generates $50 to $200 a year for them every single year for 30 years while you see absolutely nothing.
So this totally explains why Alina lost out. She walked in thinking her massive 40% cash down payment was her ultimate weapon. But in the mortgage machine, every layer is calculated based on the loan amount, not the down payment. When you put more cash down, you don't reduce the bank's profit margins, you simply reduce your own leverage to negotiate them. The lender's hidden tests, like those early pre-qualification calls, figured out she'd already picked a house and had cash ready. They knew she was emotionally locked in, so they offered zero flexibility on the fees.
Which leads us to our final section, Part 5, the 6-step defense strategy. If the bank is testing your commitment at literally every single step from pre-approval to the rate lock, how do you actually fight back and keep your hard-earned money?
You can actually dismantle their advantages by following these exact 6 steps. Step 1, get 3 loan estimates, but keep your cash position and emotional timeline a total secret. Zip the lip. Step 2, ask directly for the par rate. That's the rate with 0 yield spread premium markup. Step 3, negotiate the entire fee stack, because those underwriting and processing fees are absolutely not set in stone. Step 4, refuse their preferred title insurance. Shopping independently can save you hundreds. Step 5, get lock extension terms in writing so you don't end up paying for their delays. And finally, Step 6, ruthlessly verify the final closing disclosure line by line against your original estimate.
Listen, if you only take one single thing away from this explainer today, let it be this. The rate is not the deal. The rate is just one layer of the deal. Fixating solely on the interest rate means you are basically surrendering on the other 11 battlefronts. Greg won the rate battle, sure, but he gave thousands back in the layers underneath.
You now know more about how banks make their money than probably 99% of homebuyers out there. The invisible mechanics of the mortgage industry have been entirely exposed. So the next time you're ready to finance a home, are you ready to take back your leverage?